A 401k is the third account you need for financial freedom. Did you ever wonder where the heck the name 401k comes from? It's named after Section 401k of the US tax code. Voila! Now you know if you didn't know. A 401k is an employer-sponsored retirement account that lets you invest for your future from your paycheck. No withdrawals are allowed until you turn 59 and a half. In 2025, the 401k contribution limit for individuals under 50 is $23,500. For those aged 50 and over, there's an additional catch-up contribution of $7,500, bringing their total contribution to $31,000. The overall limit for employee and employer contributions combined is $70,000 or $77,500, including catch-up contributions for those 50 and older. And as of 2025, you can contribute up to $23,000 a year into your 401k. If your job offers a match, grab it. That's free money. Compound interest is your future best friend, especially on that free money. By the way, if you're self-employed, you won't have a 401k, so feel free to skip ahead to account number 4 in the next video. There are two types of 401k, traditional and Roth, and here's a summary of the tax advantages. Traditional 401ks are designed to lower your taxable income. Money is not taxed when it goes into your account, and your money grows tax-free. However, you are taxed when the money is pulled out or withdrawn at the tax rate you fall under when you pull it out. Roth 401k, your contributions are made with after-tax dollars, meaning you contribute from your net income, and it does not affect your taxable income. All investments, growth, and earnings are tax-free, and tax-free withdrawals as well. Here are some quick fact sheets. 401k plans vary amongst employers, especially when it comes to funds, options, and expense ratios. Keep in mind that you can take your 401k money with you when you leave your employer, but make sure to understand your vesting schedule regarding your employer contribution. Your 401k must be fully vested for you to take your employer match with you when you change jobs. Your plan is usually fully vested after a certain period of time, but the contribution you make into that account are always yours to take if you leave the company. Remember to always check the annual 401k contribution limit you can make. This contribution limit can change every year. For up-to-date information, visit www.irs.gov. It is good to keep up with what the maximum contribution is every single year. Another thing you should know is that you cannot keep contributing to your plan and let it grow well indefinitely. There are actually minimum distribution required you need to take from your 401k when you reach age 73. If you withdraw money from your 401k before you hit 59 and a half, you'll be subject to 10% penalty and taxes on the money you pull out. But there are certain exceptions. For example, if someone becomes totally disabled, or if someone has medical expenses that are higher than a certain income, or if someone is required to pay court-ordered child or spousal support, money can then be withdrawn penalty-free for these reasons. There may be more exceptions, like during the 2021 coronavirus losses, which are temporary. You can also borrow from your 401k based on the conditions set forth by your employer, which are strongly discouraged. I'm just sharing that information because it's out there. Some employers will allow you to take a loan from your account, but here's my caution note about this. When you borrow from your 401k, you are borrowing from your future. Some people will only rely on their Social Security and 401k when they retire. So when you're borrowing, you're taking away from the potential growth of that money to support you during retirement. Generally, if you are in a top tax bracket, 37%, $578,000 for single filer, and over $693,000 for married couple filing jointly, you should choose the traditional over the Roth. That's because you want to be taking all the tax deduction you can get right now. On the other hand, if you're in a low tax bracket between 10 to 32, I recommend Roth contribution. That's because your tax burden is already low, so you won't benefit as much from making tax deductible like in a traditional 401k contribution. I love that with a Roth 401k, that once the money is in the account, you literally never have to worry about tax on it again, even if your investment grow to a gazillion dollars. So if you're confused, it comes down to this. Will you rather be taxed now, that's a Roth, or will you rather be taxed later for traditional. It all depends on whether you think you will be in a higher tax bracket or lower tax bracket in the future. And if you're still confused and you really don't know which one is best for your tax situation, I'll make it really simple for you. Just choose rough. Just pick the rough, and that's it. Pay the taxes now so that the future you doesn't have to. What is it best for? The 401k is amazing to enforce long-term saving habits. Your 401k contributions are taken straight out of your paycheck so that whatever lands in your bank account on payday is what is left after you have made your 401k contribution. And since you never even see the money, you are not even tempted to use it. If you've had a hard time saving money in the past, increase your 401k contribution percentage. You will hardly notice it and be so proud of yourself when you see how much you have accumulated. Also, since you're not supposed to make withdrawals until you turn 59 and a half, it eliminates the temptation to spend that money on short-term things. Here are some tips and tricks. Always contribute enough to get all the employer matches. Never say no to free money. Never. Never treat your 401k like a piggy bank. Early withdrawals come with heavy penalties. If your company doesn't offer a 401k, you should suggest them to add this as an employee benefit. It's usually pretty affordable for companies to enable access, even if they aren't ready to offer a match. Remember this rule of thumb: match beat rough and rough beat traditional. Where's the best place to open a 401k? You don't have much of a choice since your employer makes that decision for you. You contribute to the bank your employer picks for you. Your employer sponsors the plan through a provider like Fidelity, Vanguard, Charles Schwab, John Hancock, ADP, and many more out there. Your job is to enroll in the plan, choose your investment, often mutual fund or target date fund, unless it is already chosen by your employer. And then last, you contribute at least enough to get your employer match, which is free money. To close out all these information, if you have old 401ks from previous jobs, I strongly recommend rolling over that money into your new one or do a rollover IRA, which I will detail in the next set of videos. Thank you for watching. I really appreciate you. Let me know in the comment section if you want a copy of my ebook on the 8 accounts you need for financial freedom. Just type 8 account and I'll send you the link to that. I'll see you in my next one.